Next, we have Drew Kile with Institutional Property Advisors. He's going to be talking to us about the single-family and the multifamily market. So,
good morning. My name is Drew Kile with IPA. Glad to be back here again. It's an honor to be here the last few years talking about this market. I'm a confessed data nerd. So when I make these decks and work with our research department, I look at all these slides, I get all excited, and it's hard to cut them down. So there's a lot of data here. I'm going to move through it quickly. You'll be able to get these slides later. I'm always available offline to talk through it, so don't feel like you got to tear each one of them apart. We'll try to move through it and stay on time. Let's start with projections from last year. Projected 14% rent growth in DFW. Did hit this one. We hit 14.8 last year. More of that was in the first part of the year than in the last part of the year, but nonetheless, we'll count that as a win. A little short here, but close. We hit $295 as the highest effective rent in Fort Worth, down in the Clear Fork area. So not quite $3, but we're getting close. We're in the shadow of a Southern Land high-rise that's getting built just down the street here. So more great product coming to town that'll help us keep pushing. Permits increased late last year and early this year. This ended up being spot on. We had a lot of developers that had stuff in the pipeline from the COVID era that they really wanted to try to get done. Late last year, values are coming down, costs continue to go up, so a lot of them are kind of had a no-shoot moment of, I need to close this dirt and get this thing going. So you saw a lot of deals get closed late last year to get kicked off early this year. I do think going forward, that pipeline's going to slow. In terms of going out and spending maybe $1 million in pursuit cost on that next new site in the middle of a choppy economic cycle like we're going to have in 23 is probably going to be more unlikely. So starts will remain high early this year and deliveries high, probably 23 and 24, but then slow down. Value's up 20%. If I knew how to work PowerPoint better, I would have had a line through it and like X's and all sorts of marks that I completely missed this. I want to take a poll here. So pricing peaked in multifamily last spring in DFW. Raise your hand if you think values were down by more than 5% at the end of the year. Values down by more than 5%. Raise your hand. Man, y'all are optimistic. Keep your hand up if you think values went down by more than 10% from peak to trough last year. Okay, you guys are missing it. So, look, we peaked and we've been on a run. We were selling assets at low to mid 3 caps early last year. Values probably fell from peak in the spring to last December 15 to 20% in DFW, depending on the asset we're talking about. To clear the market in the fall, we were selling assets on a trailing cap of about a 5. So you're talking 150 to 200 basis points movement in cap rate in 1 year. And a lot of that, too, was also those values fell from just lack of market participation with buyers. But we'll talk more about that here in a minute. Economic overview. Look, number one in job creation, this is the last 12 months through November, 240,000 jobs in DFW. I'm actually more impressed on the right-hand side, which is the percentage growth of jobs. For a major metro to be number one, percentage growth is impressive. But you look at job change from pre-pandemic levels. So this is before we went into the pandemic to today. That gap widens even more. I mean, we're almost 3 times as more jobs as Atlanta, which is number 2. And you kind of go down the spectrum. I mean, a lot of markets are barely positive. What's really interesting, and it goes back to the major metro, right? This is the top 10 metropolitan areas in the United States. Job change since pre-pandemic levels. The bottom 5 aren't even back to where they were before the pandemic. And 3 of those, LA, Chicago, and New York, were in the top 10 in the trailing months in terms of adding jobs, and they're still not back to positive. At the same time, we've added 334,000 jobs. So huge momentum here. Part of my theme is that momentum, it's hard to believe it's going to fall off at the rate a lot of the third-party data providers project. We just have too much in terms of that rock rolling downhill. The picture says 1,000 words. You see the lack of job growth on the coastal and northeast markets and very healthy through the Sun Belt. The projections going forward, again, this is where I start to take a little bit of offense, but the projections are for job growth to be 28,000 jobs this year. Again, it's hard to imagine we go from the mid-200s to 28, but the Federal Reserve's doing everything they can to drive this down. Looking at where those jobs were in the last 12 months, been very healthy. Professional business services in DFW right at the top. Hospitality obviously rallying back. Hotels have done phenomenally well. Education, health services, great high-income jobs. You look at Fort Worth, also a good mix of education, health services, professional business services, and also a lot of workforce housing jobs that are going to feed multifamily. So very healthy base there. Diving into housing, you've seen a similar slide, right, in migration. The biggest takeaway for me on this slide is a lot of the East Coast migration down to Florida. There's a lot of debate, but some of that could be more temporary. You got a lot of people that move from New York to Florida. Maybe they had a second home. You're hearing more and more of those folks getting called back. They're having to go back up to the Northeast. So that might not be quite as sticky. Carolinas and Tennessee probably is pretty sticky. And Texas, we certainly believe as well. I don't think you're going to see a lot of people turn around and move back to California. This leads to the demand. So we've absorbed in Dallas-Fort Worth almost 65,000 apartments in the last 2 years. Almost 65,000. That's 7.9% more apartments are occupied today than they were before the pandemic. So just massive numbers through the Sun Belt. Austin at 12%, but DFW the leader in just sheer numbers of apartment absorption. Now that's slowed a lot in 2022, driven by, I think you had a lot more people doubling up in apartments as rents got higher. I think you had a lot of people that lunged to go get that house as interest rates are moving up, so you had a lot of people moving out towards homes. But that's getting hard. So this is the delta between your average rent payment and your average monthly payment for a home. And you just see visually, and you probably can't see the numbers in the back, those gaps are widening massively. Austin went from $1,100 to $2,800 in a couple years. DFW, you look at the last 20 years, I mean, we've been in a bandwidth of $350 to $700 being that gap for almost 20 years. It quadrupled that in the last couple years to a $1,600 gap. So even as rent growth slows, even as maybe single family levels off a little bit, that gap's going to be there for a while. I mean, interest rates will come down, those mortgage payments will come down, but it's completely unattainable for a significant portion of these renters to be able to go buy a home today. And just from sheer home price appreciation, thought this was interesting. I had to add Dallas-Fort Worth on the left-hand side. We weren't in the top 10. We weren't in the bottom 10. We were kind of somewhere in between. But values have gone up 41% in the last 2 years, and we're number 19 in the country in terms of home appreciation. I mean, Austin, 65% in 2 or 3 years. So while it's still positive for us, the good news is on a lot of these metrics, we're kind of somewhere right down the middle of the fairway. We haven't been an uber hot market, as hot as it's been, and that's going to help us, help protect our downside as we go forward. This one, just take a look at one of these lines. So this is housing costs as a percentage of your income, A, B, and C. The big delta, this is national. You jump down to Texas, that attainability comes down by 25 or 30%. Where you're well north of 40% of your income. If you're in a workforce housing apartment in the United States as a whole here, it's only 30%. It's still a lot, but it's meaningfully better. And again, one of those themes of why Dallas-Fort Worth is actually improving. We were already a darling market, but as all this hits the fan in 2023, even more focus is coming into, man, where do we want to be that's big, strong, robust, diverse, lower cost of living, great place to be? It's this area. And on the same metrics, housing costs, this is multifamily, ranked by Metro. I mean, we're number 29. 22% of your income goes to rent here compared to Miami at 45. We're 29th and the 4th largest MSA in the country. This is your mortgage payment as your percentage of your income, obviously just skyrocketing. For a lot of people, your average income, it's going to take half your income to be able to buy a home today. And so those headwinds are massive, but still a big discount to 57, 58% nationally. Now, we have seen some pullback in occupancies over the last year in Dallas-Fort Worth. This is the Sun Belt, so pretty consistent. Our lowest occupancy was about a year ago at 2.7%. We're running about 5%, vacancy, 2.7%. Vacancy of about 5% today, but pretty consistent. But you look at a market like Phoenix, that was kind of one of those boom markets. Phoenix has dropped, over 3%. So again, we're kind of in the middle of the pack in the Sun Belt and in a healthy spot. This slide's deceiving, is why I wanted to put it up. The coastal markets historically have been very tight on occupancy. And they've kind of reverted back to that, where, we're at 5 or 6% vacancy, they're at 3 or maybe 4. But especially on the West Coast, you could still have in a Class A apartment 10 to up to 20% of the residents that aren't paying rent anymore, Because of eviction moratoriums on the West Coast, you can't get rid of these folks, and a lot of them have well-paying jobs, and they're just not paying rent, and you can't get them out. And so while their occupancies are high, it's very deceiving, and that plays into rent growth. So the better rent growth has been through the Sun Belt with more moderate occupancies, and the West Coast that's really tight, for example. I mean, San Francisco isn't even back to the rent level they were pre-pandemic. Their rents are still 8 to 10% lower than they were before the pandemic, and you jump over to Phoenix, they've gone up over more than 40% since then. Just massive deltas for markets that are geographically very close. Now in the Sun Belt, we are building. So we've got about 63,500 units under construction in Dallas-Fort Worth. It's a big number. That's probably a full 3-year development cycle, so it's not something to be alarmed by. It's about 7% of our stock, but you look at Austin, they're building about 14% of their stock right now. Phoenix at 10% in a market that's slowing. So we do feel comfortable about our ability to continue to absorb these units. Markets like a Phoenix or a Charlotte might see a little bit more pain going forward, and just how do they navigate absorbing that many units. This year we'll probably deliver about 25,000 units of that 63, and that'll be relatively consistent. And frankly, you know, on the absorption side, while on the left-hand side we only absorbed technically 5,700 units this year in DFW, this year we expect that to kick back up and be about 17,000. I could see us actually beating this. That's one of my projections. But this is nothing new. I mean, you look at the last 8 to 10 years, we've delivered that 24 to 28,000 units a year for a while. We've absorbed it, and while vacancy might tick up just a hair more as we work through this year, we're going to absorb these units and move forward. And as I mentioned before, that pipeline is probably going to be peaking here in 2023-ish. And as we start getting into 24, 25, those new deliveries are going to fall way off a cliff. So we're going to come out of this very strong. In the in-town Fort Worth market, very healthy. You know, we got a little soft in that kind of 2019 to 2021 range. We delivered a lot of units, just I think a little over 6,000 total. And, you know, coming off of year 22, we delivered very little. And while we jump up to 16,000 units, 1,600 units this year, it's no problem. I mean, this year and next year are less than what we delivered in 2019 alone. So we're in a good spot. We think we'll continue to see re-strengthening in the urban core of Fort Worth on the rent side. Looking at vacancy, we have seen an uptick. Again, healthy levels. This is A, B, and C. Worth noting, we go into a recession, but Class C apartments are 95.4% occupied right now. Yeah, they're in a healthy spot. They're still getting good rent growth. It took a while coming out of COVID to see that rent growth kick in, and you kind of see that here in the gold bar that rallied a little later than A's and B's. And so, you know, and we don't think what you're seeing in the headlines, right, on the layoffs is a lot more tech jobs, it's West Coast, it's different things. And while, you know, we've heard of Amazon layoffs and what have you, that, you know, there's still a strong need for just down the middle of the fairway workforce. And so we don't expect for whatever recession hits to really impact, you know, the lower quality apartments. And they've got good trajectory right now. Just breaking it down between Dallas and Fort Worth, been pretty consistent. We run mostly parallel. We've held up a little bit better recently, but either way, these are trailing 12 rent growth numbers. I do think if you looked at a beginning of the year, it was probably 20, and you look later in the year, it was probably 5. And so that average still looks good. It has been coming down. I think we'll feel good if we can do 5, 6, 7% rent growth. I think that's achievable this year in DFW, but it's going to come down from what it has been, and that's okay. Still good from a historical average. Looking at the submarkets and where we've been, Burleson, Johnson County, they kill it every year. The theme here is every single one of these submarkets has seen vacancy increase, but we're still at a healthy 5.4 on the Tarrant County side. You know, North Arlington, the bottom one, had a lot of deliveries. They've worked through that. I think you'll see that tighten up in 2023. So even the quote-unquote softest market in Tarrant County was really a little bit more of an anomaly and should pick back up. I'd also note out west, when you look at rent growth, Parker County, 20% rent growth. So a little bit of supply coming out there, but with all the growth, you're starting to see a little multi work our way out west. But, you know, South Arlington, Mansfield, historically one of the best submarkets in DFW is a laggard at, you know, 9.5% rent growth. So let's talk about sales. This is what happens when you work with data. Data is very trailing. This is not representative of the market today. So you saw cap rates continue to compress, per door values continue to rise. That was the case on the data, but you know, you put an asset under contract in the middle of the year, it closes around the end of the year, it hits the data a quarter later. So this is probably lagging by about 3/4. The reality, like I said earlier, is those cap rates really shot up as we worked through the middle of the year. Values, a suburban garden building that might have been worth $280,000 or $290,000 a unit in the spring, probably clearing the market today, right around the end of the year, $240,000 or $250,000. So a pretty meaningful fall off. Again, that cap rate went from probably somewhere mid to high 3s to 5. And it's just a function of debt. Cost of debt went from 3.5 to 6. And so people are willing to take a little negative leverage for maybe the first 12 months, but they're looking to try to get to positive leverage year 2. So if they're borrowing at 5.5, they need to get to a 5.5 cap by year 2, is kind of the theme of what's going on. My research department might kill me. I actually played with this myself last night, and it is highly accurate, but they're going to argue that probably something that I did isn't how they would have done it. What I did, though, was for 2022, we kept the cap rate the same. So the data says the cap rate's a 4.7, so I just left that alone. That is the data. But I did track what I put in. That's the peak of the 10-year Treasury in 2022. That was 4.23%. It was on October 19th of last year. That was the peak of the 10-year Treasury. The 10-year Treasury today is 3.37. So I kept the cap rate the same, but it just kind of shows how quick some of this can move, right? But it got as tight as that cap rate to 10-year Treasury spread of 47 bips. Now what's going to happen as we go through this year is those cap rates are going to go up. I think the Treasury will probably continue to work its way down a little bit. And I'll bet you if you look at this slide this time next year, it's probably a 200 to 250 basis point spread between caps and Treasuries. So again, pretty historically normal. We're just dealing with a little bit of lagging momentum there. So I threw my crystal ball out. I think it was mid-August last year, so I quit making any projections. I quit making any forecasts. I just was wrong too often, and I got tired of it. But I will give a couple. I think we'll exceed the absorption numbers that have been projected. Again, I just think the underlying economy is too strong here. We're looking at rent rolls every day. These apartments are still full. They're still getting good positive rent trade-outs. And at some point, these people need to find a home, and they're not going to do it in a single-family house. I think our rent growth also is going to come in ahead. I think the third parties always sandbag a little bit here, and a lot of it comes down, again, to just what we're seeing day in and day out in the weeds. And values will go up 10%. Now, that won't necessarily put us back to where we were maybe last spring, but we're going to have some positive momentum. I think it's going to be driven by two things. There was probably 70% of the market that was on the sideline third and fourth quarter last year. All the big money just stepped back. They wanted to play wait and see. They're all working their way back in a little bit right now. I think we'll see a linear increase of buyers that are active in the market. Just the relative consistency and lack of volatility we've had over the last couple of months on things like debt, the 10-year Treasury are going to help. And so it's going to be market participation. I think you'll see Class A cap rates come in a little bit. I do think you'll see a wider spectrum. Instead of everything trading at a 3.5 from A to C, you're going to see C's maybe at a 5.25 or 5.5 for a little while. But you're going to see A's kind of tighten up and B's somewhere in between. But it is positive. We're going to have to work through the next 12 months. I don't know exactly when it's going to pop, but I think there's broad consensus in our industry that we've got a really strong next 3 to 5 years. We got to get through this one.